All right, let's get started. And we are going to get ready to have a look at the Business Risk Index for November. Quite a crucial month as we navigate out of lockdowns and state borders start to open back up. Of course, as always, we have James O'Donnell joining us as well. Unfortunately, my camera is not working, so I'll have to keep that off. James, it's totally up to you whether you want to put yours on.
Good to be here, Pat, as always.
Yeah, great to have you along. So thanks for joining us again. Thank you for the work that's gone into this. As always, just some housekeeping and then a little bit about CreditorWatch, and then we will get stuck into the numbers. Ultimately, if you've got any questions, please do ask them in the GoToWebinar control panel. There is the question section, which I would encourage you to ask questions along the way, and we will look to either answer them at the end, or if I spot any really good ones that are timely, I'll jump into those straight away. The other thing I wanted to talk about, of course, CreditorWatch, commercial credit reporting agency with over 55,000 companies across Australia using CreditorWatch to better assess the credit risk within their business, using it for things like online customer onboarding, rather than using paper-based credit application forms. Provide a much better automated experience for your customer, but also gives you the ability to make decisions, credit decisions in real time to approve, reject, or refer applications. A wide variety of credit reports, credit ratings, payment ratings as well, so you can understand how businesses are paying their bills. Are they likely to pay you? What sort of probability of default do they represent if you were to start doing business with them? Very simple. And of course, monitoring alerts, very powerful tool there. You've got your existing customers. How do you know that they're going to be around tomorrow? How do you know they haven't gone into administration or have stopped paying other suppliers? So set up monitoring alerts on your customers. The next slide we look at basically has a list of, or a good sort of highlight of the data that's coming in, and this starts to paint a picture as to what information are we getting access to, and how are we able to make predictions and ultimately rank 300 odd regions around Australia from best to worst, and also of course looking into industries too. So a huge amount of data that we're pulling in from public, private and government data sources, able to report on all the way down to an individual entity anywhere in Australia. If they've got an ABN or an ACN, we can tell you what sort of probability of default they represent to your business, identify the directors of companies in Australia, and of course a lot more. But what we are here today to discuss is the November results for the Business Risk Index, and I will throw to our colleague James O'Donnell, who is of course the Managing Director of Open Analytics that we partner very closely with, and also the creator of the index. So James, over to you.
Thanks very much, Pat. Now look, I'm going to describe this month's results as a bit of a mixed bag. So there's some negative sort of indicators, but also a few positive ones as well, looking at different regions. So look, to start with, underneath the index is really, it's all about default prediction and probabilities of defaults. So the picture we're seeing this month is we've just sort of seen that turning point where default rates, the actual default rates, are starting to go up. So this sort of figure on your screens there basically shows that split by the national average, which is the middle line there, and the sort of best and worst regions as sort of separated by the Business Risk Index. So the latest month is really the first one in quite a while where we've actually seen the actual default rates go up. And our sort of forecast, I think, as we mentioned last month, is that that's going to sort of start to climb over the next 12 months. Just another sort of view on that, sort of more sort of spot sort of numbers looking at the current month. So this chart sort of shows the number of external administrations. So this month we did see a bit of a spike in those, and then sort of looking at a sort of 12-month window, we're actually expecting those default rates and liquidation events to start going up. Sort of, I guess, another.
Sorry, James, I might just jump in there as well. Obviously, external administration is probably the second or third most reported on number after vaccination rate and number of cases. It's interesting to see that jump quite soon in November, probably sooner than we expected. But it's also, I think, a positive sign that we're getting back to a normal collection rhythm. Businesses are getting back to a normal collection rhythm. Still well down on pre-COVID numbers, which is the high 700s, low 800s. It'll be remains to be seen when the ATO and the banks really start to put their collection rhythms into place. But this should continue after the Christmas break, after December, Jan.
Absolutely. And they just another sort of similar metric around sort of court actions have spiked a bit this month as well. So look, nothing drastic, but we're definitely seeing the early signs that certainly the reduction in insolvencies we think is over. Looking at a state view of the world, so looking at sort of the major states, similar story to last time, sort of South Australia sort of at the top, poor old Queensland down the bottom, and that largely being dragged down still by the Gold Coast region. And then, as we discussed last month, sort of bit of a convergence of New South Wales, Victoria, and Western Australia, which for Western Australia is quite a big improvement, but for the other two, it's actually a bit of a deterioration. This month, we've really been focused on the major city CBDs. So this sort of chart shows the index over time for the major capital cities. And the story here is that both sort of Perth there in yellow and Brisbane in orange there are the sort of biggest improvers up the index over the last quarter, and sort of Perth certainly over the last sort of 12 months. And then sort of contrasting that, sort of, Melbourne in particular is quite depressed at the moment. And sort of Melbourne and Sydney have basically got the highest probabilities of defaults that we've seen sort of in recent history. So it's still a bit sort of the major cities in the doldrums, but some of the other areas are starting to pick up. So just to zoom in on that, sort of comparing sort of Melbourne to Perth here. So you see Melbourne sort of declined. So recalling what the index measures, it's a relative ranking of insolvency risk. So Melbourne sort of deteriorating down there basically means the default rates and default likelihood has been climbing. So whereas sort of in the past it was sort of around the average, today it's sort of really sort of heading down towards sort of that sort of magic number, that sort of bottom 20%. If you get an index below 20, that tends to be a very high risk region. And then Perth, Western Australia as a whole has been performing quite well. So, but Perth in particular over the last sort of 6 months has climbed up the ranks, and which again essentially means that the insolvency risk is reducing in that area. On the trade receivables, now this is one where I sort of said a mixed bag. I was actually expecting our favourite sort of turnover measure. I was actually expecting it to bounce back in November, given we sort of had the two big major cities, fully out of lockdown for the November month, and we had the sort of Black Friday sales, but it didn't give us the bump that we expected / hoped for. And we sort of believe the supply chain and sort of labour shortage issues are factoring in there. But potentially on sort of to contrast that, sort of on the potentially a few green shoots we're seeing in terms of number of credit inquiries. So, whilst the kind of small business turnover is still very low, we are sort of seeing more sort of credit activity. So we're sort of seeing the number of inquiries has jumped, and that's sort of mirroring some of the things I'm seeing at some of the banks that we're working with, that where loan applications are starting to pick up again. And I know this is sort of one of Patrick's sort of favourite measures of business activities as well. So Pat, I don't know if you want to sort of chime in on that one.
It's a sort of great indicator of business activity, full stop. I think I call it the heartbeat of of commercial trade, because it's essentially debtors and creditors talking to one another, which is always positive after so many months of treading water or hibernating, and we've kind of seen those jumps over the last what is that, about 20 or 22 months. You can sort of see as through the middle of 2020 we saw credit inquiries sort of start to tick up as we got on top of the case numbers, and then obviously lockdowns brought that back down, and then the start of this year was very positive, and then of course the sort of East Coast lockdowns hit again, and then it fell away. So I think this is really positive. It's no surprise, given a lot of businesses would have been ramping back up. They had that certainty around borders opening, lockdowns coming to an end, and we know it takes businesses time to get up and running. They've got to hire, they've got to order goods, etc. So this is a great sign. And while December, Jan are typically slower months, you can see that historically. That the fact that it's already started to climb and back up to what's that, the third highest month in the last 22 months is a really positive sign.
Okay, so then looking at sort of major sort of population centres, so we're looking at the sort of movements in the index over a quarter. So this is basically looking at regions that are going up and down the ranks. So as I sort of mentioned towards the left of that chart, sort of Brisbane CBD is the biggest mover over the quarter. You can see sort of Perth on that list as well. Perth is actually the biggest mover if we look at a sort of 6-month window. So those two sort of interesting. Well, of course, the states that have been the most, let's say, isolationist in terms of closing borders, but internally they've had quite more relaxed restrictions around COVID simply because they've got much less case numbers. So that's sort of an interesting story there. We're also seeing a bit of a bounce back in the really high risk regions in Western Sydney, so around Bankstown, Strathfield, Burwood. So look, they're still high insolvency risk areas, but we have seen them sort of bounce back a little bit. Then on the flip side, sort of the biggest sort of deteriorators actually among sort of northern Sydney suburbs, although I would say those sort of North Sydney areas are still below average insolvency risk, but they've sort of deteriorated a bit over the last sort of quarter. And similar, there's a couple of the bigger sort of Melbourne suburbs in there as well that have gone backwards. And then sort of finally on this section, looking at sort of in absolute terms, the kind of top and bottom, I've put a filter on regions with at least 5,000 business, so credit active businesses or companies. So just to sort of filter out the more regional areas again. So at the top of the list for these bigger areas are basically areas in South Australia. So Unley and the capital city or CBD of Adelaide, sort of the top rank there. Then you've also got Cottesloe, Claremont within Western Australia, Yarra Ranges within Victoria. I think we've touched on in earlier sessions on sort of the regional tourism in both Victoria and New South Wales are actually quite strong. And then sort of Chatswood and Lane Cove, another sort of North Sydney area. On the sort of the bottom of the index, it gets same story. It's basically areas around the Gold Coast and Western Sydney. Although, it puts it in perspective with sort of Bankstown had bounced back a little bit, obviously from a very low base. Okay, so that sort of concludes, I guess, the regional or geographic view. So that we'll finish with a bit of a look at industry. And Patrick, I know you love to talk about industry, so I might give this one to you to talk through.
Yeah, and I'll get to that. Thanks, James. I do like looking at these ones, and it always comes up in conversations with clients and companies we're talking to as well, which is good. It's a good couple of slides, and we're sort of happy to share these with anyone who wants access to them. But yeah, it's great to see the slides that you focused on, or the stats that you focused on this month, James. In particular, the CBDs. We've had a lot of queries about that since we sent out the press release yesterday, and obviously came out of embargo this morning. A lot of changes. It'll be interesting to see what that looks like. Obviously, on the other side of Christmas, it feels to me that December is going to be quite busy, like last year was, right up until Christmas period, and then it'll be a very, very, very slow January as everyone takes stock and relaxes, and I think recuperates from what has been a very long 2 years. So look, let's jump in and have a look at the probability of default by industry. So this is forward-looking, essentially looking at the chance of a company becoming insolvent within or a company within an industry coming insolvent in the next 12 months. So food and beverage services, as it has been for quite some time, way out in front, and I believe that the gap between sort of first and second has extended there, which is certainly concerning. I think the question I'm being asked is how bad is it for those food and beverage service providers, and the fact is that if the restaurants and cafes can get back up and running and have a really good trading December, that's really positive. I think they're going to be well supported, as are all businesses, through December, Jan by the banks and the ATO and other larger creditors, and hopefully that means they have a chance to get back to normal sort of trading rhythm come Feb. But without a doubt, they are the ones that are doing it the toughest. If you then sort of divide these between, small and larger organizations, we know that, smaller businesses just don't have access to, public capital markets or debt facilities, the same sort of debt facilities that much larger organizations have. So they've certainly probably eaten well into their savings, potentially, remortgaged and gone through their overdrafts and whatnot, and will be hanging on by a thread. So it's extremely tough out there for smaller businesses within these industries to the left of the graph. It's quite even through the next sort of 5 or 6 or 7 or 8, to be honest, from that 4.1% with arts and rec through to 3.5% at professional, scientific and technical services. Arts and recreation, very aligned to food and beverage, of course, reliant on lots of people, volume, and people coming through. It's hard to provide virtual services, though they are certainly doing a good job. Education and training, still very reliant as well on international students coming in, and that's been somewhat delayed again. And then at the opposite end of the spectrum, good news story for obviously what I like to look at: agricultural, forestry, fishing, and also the manufacturing industry. No surprises that the mining is doing extremely well too. If we look at the next slide, it's going to talk about payment arrears by industry. So that's the proportion of businesses with 60+ day trade payment arrears. The one that's often at the front and still is construction. We know that they are consistently slow paying business, slow paying industry, though not necessarily translating into becoming, the highest probability of default, for example. However, there's certainly a lot more pressure on this sector at the moment with supply chain issues, accessing, the raw materials that they require, not only just being able to access them, but also those cost blowouts in that space too. So very, very important that, builders and contractors and whatnot are getting their quoting right, so they maintain their margins. But then, of course, the financing side of things, if projects are delayed, it means project finance is delayed as well, and that means ripples up and down the supply chain, particularly to subcontractors. So there has been a few notable collapses in the building industry in the last sort of month or so. These sort of tend to occur. You see some big sort of media announcements and discussion around them, but it happens even in boom times as well. But they're certainly under pressure in that space. Information media, telecommunications, energy, gas, waste, services, rounding out the top 3 there as consistently slow paying businesses, industries. Retail trade is an interesting one, of course, done it very tough, but it's one of those industries where we could try to break it up between probably 3 categories: those with bricks and mortar only, those that have got that sort of omni-channel bricks and mortar as well as online, and then the online onlys, which are doing exceptionally well, of course. We all know about. Other end of the graph here, education, training, despite being a high probability of fault, they're good payers. Agricultural, good payers, and of course healthcare and social assistance as well. So overall, no big shocks or surprises in here. December, Jan is always an interesting one because you have, some industries are very busy, some are very quiet. January, most are quiet, and then there's not a lot of people in the office as well, or on the phones doing, bill chasing, collecting, and also the bill paying as well. So we typically see payments can blow out somewhat in January before coming back to more sort of normal levels in Feb. And I think Feb for me is the magic month. March has always been my favorite month. Coming from a sales background, I found, December, Jan, obviously slow. Feb is, you get back into it, but it's a short month, and then you finally get a 31-day month in March, and everyone's certainly back into it. So for me, I'm sort of putting a flag in the ground for the month of March to be a boom month, notwithstanding any new variants that cause further disruption or even just uncertainty, as we've seen with this latest variant. Certainly put a bit of uncertainty into the tourism and travel industry at the moment. All right, so no questions have come through. which is fine. It means we've done a great job of explaining everything, James. So well done there. Did you have any final thoughts or comments to make about what you're expecting to see?
Yeah, look, I think the realistic picture is that we're expecting to see a little bit of pain in the short term, so the insolvencies to go up. But similar to yourself, Patrick, I am expecting, although I'm mindful that I've predicted this last time, but I am expecting that sort of trade activity to pick up. So yeah, that's basically the way I see things going, hopefully.
Yep, I agree. If we can keep everything on track, we're looking really good, and I think I'm quite optimistic, and you are too. You have been for a few months, despite November throwing up a couple of little wobbles.
Yeah.
All right, great. Well, I'll finish up there. So appreciate everyone's time for attending today. Thank you as always for making it through to the webinar. We love doing these, and of course we will see you in the new year. Don't forget to jump onto the website creditorwatch.com.au/business risk index, and I might see if I can take over and show that very quickly. You can jump onto the website and actually have a look at some graphs. So let me see if that works. There we go. So you can actually jump onto the Business Risk Index website and have a look at the regions specifically, zoom in, see which ones are doing really well, which ones are struggling, where you might live. So you can see the red around Western Sydney here, which has been touched on as being one of those struggling regions. And then of course, from a state breakdown perspective, you can see how the states are ranking as well. And don't forget, you can also have a look at probability of default, not only by state, but also by industry. No surprise there. All right, so thank you everyone for joining us today. Great to have you as always. If you have any questions going forward, don't hesitate to contact us. If not, we will see you in the new year. Have a fantastic Christmas, a safe Christmas and a safe new year. Enjoy the break, and we will chat to you very soon. All the best. Thanks again, James, for joining us.
Thank you.